Hey guys, it's Canadian Kyle here at the Wealth Wars podcast, and today I'm joined with Kevin MacLean. He's the Chief Investment Officer at STRR Royalties, ticker symbol is STRR on the TSXV, and they have a few differentiating features of their company, and they are one of the newer royalty and streaming companies out there, so I'm excited to have them on again. Kevin, it's nice to have you on. I did have Alex, the CEO, on not too long ago. I liked his
Great.
story, but he couldn't praise you enough, so I'm very honored to have you on the program.
Thanks for having me, Kyle.
So I start this off with first-time guests by asking the same question all the time. But before I do, listeners out there, I highly recommend you check out Kevin's conversation with Bill Powers at Mind and Stock Education. He went into depth about Kevin's early 20s, and it was definitely worth a listen. That whole conversation was chock full of information. So highly recommend, check it out after you listen to this. But Kevin, I do have to ask this question. What were you doing when you were my age? I'm 26. So what were you doing from 20 to 26 years old?
Yeah, so I graduated from university when I was 22, had a degree in nuclear engineering. So I joined Ontario Hydro as an engineer and worked in their nuclear generation division. But I also started getting a paycheck. So I started to invest for myself. And after a couple of years, my broker offered me a position to work with him, which after some encouragement, I finally accepted. And I joined the investment world. And at age 25, I became a partner and director of a Bay Street investment dealer. And that was it. So by 26, I was fully into the investment advisory world.
And you've earned a lot of respect in the investment advisory world. You earned 13 Lipper Awards. So what is a Lipper Award exactly?
Yeah, it's an award that measures your risk-adjusted returns. So it compares the returns that you make in the market with the volatility of those returns. They look at something called the Sharpe ratio, and they figure out whether you're making returns in a more steady fashion or in a more volatile fashion. And I guess my returns were more steady, so I managed to win a few awards.
Just a few. And I've heard this terminology you've used, a wealth creation portfolio before. Can you explain a wealth creation portfolio? Because a portfolio that increases in value, isn't that creating wealth?
It is, but your portfolio can increase in value for a lot of external factors that have nothing to do with the investments that you own. So for example, if interest rates fall, typically stocks go up. If there's bad news from China, stocks might go down. And that really has nothing to do with the portfolio of companies that you own directly. So for me, in the mining world, I define wealth creation yield very specifically. It's the change in net asset value of one of my holdings driven by an increase in gold inventory that's brought about by discovery and exploration. So to give you an example, if you've got $2 million cash on your balance sheet and you take that and you spend it on a 10,000 meter drill program, and then you find 50,000 ounces of gold. So 50,000 ounces of gold is worth 90 million bucks on a gross basis. When you allow for the cost to extract the gold and taxes and all that sort of thing, the time value of money, that might be worth 30 or 40 million to you. So in a very short period of time, you've taken $2 million of cash and created 30 or 40 million dollars of value, which, you know, for a $300 or $400 million company, which is typically the size of investment that I would own, it's a 10% perhaps return just from that drill program. So it's very important that you anchor your portfolio with companies that have the ability to do this. And the way, by the way, that you get less volatile returns in the market, particularly over my career where gold has been quite volatile and for much of my career didn't go anywhere. You have to have a positive return driver in your portfolio to offset the volatility in the sector. So even when shares are going down, you'll have companies like in good old days, a Cisco, the shares are going up because they're discovering more gold. It doesn't really matter if the gold price is down $100, their shares are going up. So your overall portfolio is less sensitive to the downturns in the market.
Okay, that makes sense. Makes a lot of sense. And it makes sense why you're a CIO of a royalty company. They're kind of built into the model. So I have a lot of questions for you today, but I know a lot of people are interested in this Green Star Royalties spinoff. And I want you to just explain, where do you see the 80-20 portfolio split? What do you see in that 80%? What do you see in that 20%? How do you see it getting broken down? Like, will there be battery metals included or? Yeah, just explain the assets.
So when we started STAR, we wanted to have a green component in the company's portfolio, but we're all precious metals guys. That's our background. So we thought, look, we're going to focus on 80% precious metals in the portfolio and 20% green, which would also include battery metals, nickel, lithium, copper. But we started with a couple of novel royalty ideas. We set up 2 carbon sequestration royalties based on forestry properties in Canada. And we found that A, the returns on those were more attractive than in the gold sector. B, by getting into that area with a qualified consultant from the US, we found that we had just an enormous amount of opportunity open to us in an area where there's no competition effectively. So rather than having to compete on a gold mining asset with 6 other guys, this is basically us doing what we could by ourselves with no one to compete against. So we thought, look, there's also a lot of shareholder interest in the green space. A lot of portfolios now are being mandated to be greened. So we thought this is going to help us to attract capital to our story if we can accelerate the green aspect of our portfolio. And it was quite possible because a lot of these opportunities are very scalable. Getting more forests, you can scale up very quickly. We're looking at regenerative agriculture in the US. There's 1 billion acres of farmland in the US. So these are very scalable opportunities. And so we thought we cannot limit our ability to invest in the green space with this 20% somewhat arbitrary cap that we put on the model at the start. So we thought, let's create this subsidiary. It's not a spin out yet, it will be eventually, but a wholly owned subsidiary now within STAR that can be funded independently of STAR, so prevent any dilution at the parent company level, and then bring in a capital partner and help ourselves to grow this business basically as fast as we can. So the 80-20 is out the window, I'll tell you right now. It's going to be as much gold as we can get our hands on, of course, but we think we'll scale up the green faster. And we think we'll have better returns for doing so. So 80-20 is out the window. When we get the Green Star Royalty subsidiary grown or incubated to, let's say, $100 million of value, then we'll spin out. We'll go to the public markets and make this a public vehicle because there's very few of them. So we think the demand for this sort of investment product will be quite high. Okay. And by the way, the battery metals, we'll still do them, but we'll do them at the Star Royalties parent company level. We won't do them within Green Star because a lot of green investors don't like mining no matter what you're doing with it. So they'll be somewhere else. And also no hydrocarbons. Okay. Too many green investors don't want any hydrocarbon assets.
Right. And you're focusing on a goal of net negative, carbon negative, right, with the Green Star?
Yeah, so our existing portfolio, and we have 7 investments, and we're ramping up to 6,000 equivalent ounces of gold. Despite that, with our 2 forestry investments that we already have, we're going to be net carbon negative gold in sum by 2023. So as all these mining companies and others try to get their carbon footprint to zero by 2030, 2040, 2050, whatever it is, we're going to be there in 18 months. And we're going to be net negative gold. Will be uniquely, I think, the only net negative gold asset on the planet.
Okay. And I think a lot of people are interested in about the opportunity with this carbon credit section. Like you said, you're the first ones new to the space, not much competition, but it's because it's new, people might be hesitant. What does this mean? It's not like a metal commodity where you have a historical cyclical past. This carbon credit, what's the value of a carbon credit right now, and where do you see it going in the future?
So there's different ways to value carbon credits. They're in different types of markets. There's something called a compliance market, which is a market where pricing for carbon credits is set by the government. They're saying the price is this, okay? Next year it's going to be that. And at the moment we have China, Japan, South Korea, Canada, the UK, and Europe with compliance markets. The governments have said, we'll pay this for these credits. Other countries around the world, including the US, have voluntary markets where the market decides what the price will be. The trend of those credits is still up. And the reason why it's still up, you can summarize in a bit of a thumbnail. If you look at Shell Oil, for example, if Shell wanted to completely offset their carbon footprint, they would have to buy $200 billion worth of carbon credits per year in a $300 billion market. So Shell alone would basically sweep all the carbon credits off the planet. And so as the entire world tries to decarbonize, there's a necessity for the carbon credit market to grow by orders of magnitude. And so in order to do that, to induce people, first of all, to meet demand, the price has to go up. To induce emitters to act more green in their business model, the price has to go up as unfortunately, a bit of a penalty for them if they don't act green. So we have a bull market in even the voluntary market built in. But for example, here in Canada, the Liberal government has set up a compliance market with carbon credit pricing preset. This year, 40 bucks a ton, next year, 50, the year after 65, and then up 15 bucks a ton per year until 2030, when it'll be $170 a ton. So you've got a built-in bull market in these carbon credit royalties. We're not paying for that price curve, but we're paying more or less near spot for what we set up. And then if that carbon price deck continues, we'll get the benefit of that.
Okay, that's a great explanation. Thank you for that. And you say it's going to be better returns, or you see better returns than the precious metal space. So I wanted to get your thoughts on the value of gold and silver right now, with COVID throwing a wrench into the whole world and all these governments printing money. Do you think it's a fair value at 1,800 gold, $24 silver?
I can answer that for you, but let me give you a little bit of background on how to determine the value of gold and silver from my experience. So back in 1997, I joined the Royal Bank of Canada as a senior gold mining analyst. So I had to forecast the gold price. It was part of my job responsibility. So I thought I better get to work on this and figure out what I think is going to determine the price of gold. And so I regressed the behavior of gold, the price behavior of gold, against every known variable that I thought could possibly affect the gold price, whether it was oil or interest rates or the dollar or whatever, economic activity, money supply. And at the end of that search for understanding, I concluded that the only parameter at that time that really mattered on a statistical confidence basis was, interestingly enough and very simply, supply. If you could forecast supply, you had a 78% correlation with the gold price, which is an astoundingly high correlation. And so supply wasn't that hard to forecast. You could tell what the mines are going to produce. You knew how much scrap came out every year. You could sort of forecast what India was doing. And that was basically it. You got to a very narrow range of supply. So you could forecast the gold price going forward based on that. And I used that successfully in my career. But to prove the thesis, you know that gold got down to $250 in 1999 when various central banks were liquidating gold. And at the time, I was pounding the table to accumulate gold and gold equities because the supply correlation suggested you needed 4,500 tons of gold to keep the gold price anywhere near 250. At that time, the mining industry was producing about half of that. So 2,200, 2,300 tons. You're getting 600 tons of recycled scrap every year. And the rest was basically coming from disinvestment. Central banks transferring inventory from their vaults into the market, or hedge funds borrowing gold from the vault and selling it short to take advantage of what the central banks were doing, pressuring the price lower, or companies borrowing gold from the vault and selling it because they wanted to hedge their gold production. And that hedging industry kind of dried up in 1999 because there was no point hedging gold at 250. It was below your cost of production for a lot of guys. The only company that really persisted in doing that was Barrick. And they did it, by the way. I had a conversation with Peter Monk at the time, and he said, we're going to continue shorting gold at 260, 270, whatever. And I said, why would you do that? You got a $2 billion profit on this and gold's not going to go down. And he said, yes, but if we can keep gold down for a while, then Newmont and Kinross are going to be financially distressed. And we can buy them cheap.
Right.
So that didn't work out too well because that $2 billion profit turned into a multi-billion-dollar loss as gold eventually rallied. And as you know, if you study history, the reason why gold came out of that funk is because they did this agreement on gold to cap central bank gold sales at 400 tons a year. And that was it. There was no ability to keep the gold price at 250 from supply. So how did that work out going forward? If you look at the price action in gold from 1999 to 2011, the gold price went from 250 to almost 2,000, so almost 8 times. We don't have to explain why, but that's what happened. And then if you look at what happened in supply, it went up maybe 20%. So 8 times increase in the gold price, 20% in the supply, the correlation was shot. It no longer worked at all. And when you got to the financial crisis of 2008, 9, 10, 11, the world changed, and you had to come up with another way of figuring out what the gold price should be in the face of quantitative easing and zero interest rates and that sort of thing. What really should gold be? So I think everybody on the planet was struggling to figure out, what the correlation should be and where should gold trade. For a period of a couple of years, gold did track very nicely the increase in US debt, and it did track very nicely the increase in US money supply. Those were the two factors that seemed to correlate with the gold price. And so when gold got to 1900, it was pretty clear that the US debt and was going to keep going, and interest rates were going to stay low for a long time. So you wouldn't naturally sell your gold on that basis. But nonetheless, that correlation just disconnected in 2011, and gold retreated sharply while the debt kept going and the money supply kept going. So what's going on? The only thing I can offer an explanation is that the S&P 500 clearly was recovering and about to break out to new highs. And I think people said, okay, it's a risk on market again, where you don't need gold to protect you because the stocks are doing fine, everything's cool. So then when gold came down, it's banged around, and from 2011 to now, the gold price today is still about 10% or 8% lower than where it was in 2011. So where's the correlation in the last 10 years with all these factors? Directionally, real rates are still low to negative. Deficits also correlate with gold. The trend of deficits is up, which means the trend of gold should be up. But it's hard to correlate any of those things with where the gold price actually is trading today at around 1800. So my thought on this is the world changed in that 2008, 9, 10 period. We moved from whatever was before into this new quantitative easing dependency. I'll call it dependency. And so I had a look at what gold traded at in 2008. It peaked out at 1,033. It bottomed at 682, I believe. At 682, could you say that was the fair value of gold at that time? I would say no, it was below fair value, because that 682 price came in the face of massive liquidation, margin calls, forced liquidation, fear, get me into cash, okay? So that wasn't the fair price. The fair price was somewhat higher. I don't know what that fair price was, but I would say it's reasonable to take the midpoint of the trading range that year, which is about 858, and say, okay, that's close enough to fair value at that time period. And since then, in this new paradigm, what's happened, gold's gone from that 858 to 1800. Actually, as of this month, October, it's been 13 years since the bottom. And if you look at the compound rate of growth in the gold price from that baseline starting point, it's 5.8% per annum. Now, that's an interesting number to me, because if you take 5.9% and compound it for 40 years, you get a 10 times return, okay? And why that's interesting is that in my lifetime, I'm old enough to know what prices were 40 years ago, okay? On all the major things that mattered to me. And all those major things are 10 times higher in price today than they were 40 years ago. And for most of those 40 years, interest rates were high, real rates of interest rates were high, inflation was modest, but nonetheless, in my life, sort of a 6% baseline inflation is what I've experienced, okay? And so it's interesting to me that this 5.8% compound return since 2008 is pretty much the 6% return that I've experienced for most of my life. And if you accept the fact that gold reprices itself as money in a debasing currency, it makes sense that gold should be advancing in price every year because the government's continue to debase currencies. So what we're seeing, and what I'm concluding here, is that the gold price since 2008 has just resumed its regular price appreciation of 6% a year, which is interesting because it means the market is giving zero value to whatever financial distress is in the system and whatever financial distress is building and is coming based on what we know about the fiscal policies of the US, et cetera, and the rest of the world going forward. So today, I would say the market is pricing gold fairly, which may disappoint your listeners. It's pricing gold fairly, except for at some point in the future, it's going to reprice gold in a quantum leap higher as confidence erodes in the system for whatever reason. And it'll probably be a reason related to credit quality in the sovereign debt market. So right now, people are quite happy, and maybe not happy, but they're doing it. They're loaning money to governments around the world for next to nothing. And they're doing it because the central banks are supporting it and saying, you can't lose.
Right.
So go ahead and do this. But at some point, that'll change. And if the Fed ever tries to taper and back off, it'll change. So what you're getting now, and I think what you should expect as an investor, is for your gold price to sort of go up at 6% a year, while everybody views the world through rose-colored glasses, that things are fine, and then go up faster later. But the key thing is it's going to go up. It may not go up 6% every year, because it certainly hasn't in the last year, but it will revert to that 6% rate of climb over time. Okay, if you look at any growth path of any asset class, if it's growing like this, it's always above and below, right? So that's what's happening with gold. And I would say to your listeners again that gold is fairly priced, but trending higher. So don't worry about the gold price. Don't try to predict it. Don't worry about it if it goes down $100. Just get your portfolio positioned in gold as an asset class, whatever you think. And most studies say that 6% is ideal. I'm personally closer to 20 because the times we live in are quite unique. So I think somewhere in that 6 to 20% range should be your portfolio weighting in gold assets.
Okay, thank you. That was an amazing explanation. It makes so much sense. I really like that. You're saying put your place in gold, and I want to know, with your portfolio allocation with STAR Royalties, first thing I look at when I looked at your company, I was thinking, geez, you're placing a big bet on one asset, Copperstone. So can I get your thoughts on that and your justification behind that?
Yeah, well, you got to start somewhere. And
yeah,
I think Copperstone was our fourth asset. We had a couple of small exploration assets to start. We had a cash flowing asset in Australia, which we did to get our overheads partly covered. And then, of course, we're looking for an initial precious metals cash flowing or near cash flowing asset. And we got to Copperstone after looking at a lot of opportunities, which didn't check all the boxes. But Copperstone did. We did a lot of due diligence to make sure that it did. So you want to look at your jurisdictional risk. They're in Arizona. It's like the top mining place on the planet, so no problem. Your regulatory risk, they're fully permitted, no problem. Your technical risk relates to primarily grade and recoveries. Do you have confidence that they're going to achieve what they think they're going to achieve? And then you have to look at what their all-in sustaining costs will be. And can we put a royalty or a stream on top of that and still leave them with enough margin to be comfortable? So that last point rather is a fourth factor that's financial in nature. Sure. So financial at the operating level and then financial at the corporate level. Does the company have the wherewithal with our financing to make this happen? And that last point, we had an understanding and agreement with Arizona Gold at the time. Now it's called Sabre after a merger, that they would fill in the missing capital to get this mine built, which at the time was about $5 million. We fully expected that to escalate a lot. In fact, we forced it to escalate by a few million by insisting on some technical changes to check off our technical boxes. So Sabre needs to come up with a few $1 million to make this happen. But on the technical side, going back to grade and recovery, there's two aspects about the mine that required some obvious attention from our perspective. This is a mine that had operated previously under Cyprus AMAX in the late 80s, early 90s as an open pit. So it was producing gold at 2.8 grams per ton from the open pit, 97% recoveries, just leaching the ore, very conventional, fantastic recoveries, actually. That asset was deemed to be too small for Cyprus AMAX. So they let it go. A company called American Bonanza got their hands on it, and they tried to operate it 7 or 8 years ago to do something a little bit different. They wanted to produce copper and gold instead of just gold, because this ore body has about a 0.25% copper in it. It's very low, but it's recoverable. And so they set up what's called a flotation circuit to produce a concentrate containing both copper and gold that we sent off to a smelter. So the first problem with that is that the smelters generally don't pay well for small batches of concentrate. You tend to get a very low payable value. So they had that sort of headwind against them to get going. Secondly, when you're starting to mess around with copper and gold, they tend to conflict with each other a little bit in terms of recoveries. And so what Arizona Gold was planning on doing was to keep on using the same flotation circuit to recover copper and gold, but just leach the concentrate with cyanide to recover the gold and not send the concentrate off to a smelter. And that can work, but without getting too deep into the technicals, the pregnant solution containing the gold and the copper, in my opinion, would have had about 12,000 parts per million of copper in it. And to give you a comparison point, Torex Gold had a mine in Mexico called El Limon that had 1,000 parts per million copper in it. And their recoveries were well below what they expected because the copper concentration was too high. It competed with gold for the cyanide, and they had to put in a separate circuit called a STRR circuit to get everything out and improve, but that cost a lot of money and a lot of time. So in my opinion, I thought that this Copperstone mine could be at risk of having a disappointing startup because recoveries wouldn't meet expectations and maybe more capital would be required to fix the problem. It could be fixable, but it would take time and capital. So we said, look, why don't you just spend a few $1 million extra, go back to the whole ore leach situation and get your 97% recoveries. And by the way, that'll pay for itself in about 7 or 8 months of operation. So don't cheap out on the capital. And so they agreed to do that, which was a plus that checked the box for us. And then the second thing was grade. This is a relatively, I'm going to say relatively high grade underground mine these days. It's about 7.3 grams per ton reserve grade. And that's excellent. But you want to make sure that that grade is real. Okay. So what we did with SRK and with the consultancy firm that was calculating the reserve and resources for Arizona Gold at the time was to say, look, this ore body has a lot of high grade intercepts in it. And normally when you get a lot of high grade intercepts, like multi-ounce per ton, you'll cut the value of those intercepts down to say 1 ounce per ton. Okay. And then when you're calculating your reserves, you'll allow that high grade drill hole to influence a certain area around the hole as what you expect the grade to be. And there can be some error in that. The capping to a certain level helps, but it's not the whole story. You have to be careful how much volume of rock you allow that high grade to influence, because sometimes the high grade could be right here and it's not 2 feet away. So what we did with this reserves, we asked the consultant to recalculate the reserve by cutting the area of influence of the high grade in half. So a fairly draconian cut, and said recalculate the reserves based on that. And they did that, and they came out with a 3 or 4% less number, which was to me was exceptionally good. It meant that they were being relatively conservative in what they were doing. We then asked SRK to recalculate the reserves in any way they wanted to. Just here's the data. You figure out what you want. So they did the same process. We didn't tell them how to do it. We just said, be conservative. They did it, and it was about a 3% difference. So we're very confident that the grade is there, and we're confident the recoveries are there. So that was check on the technical side. And then we were good to go, and we write the check. And once you decide you've got a good investment, you put as much money into it as you can afford with the portfolio at the time. We wanted to put more money in, and we did. And I will say this, the one negative superficial aspect of this, and in my mind, not superficial, but one negative parameter in the minds of some investors is that the official reserve life is 4.5 years. Right. And we paid for a 7-year mine life that we thought would work. Since that time, by the way, the company's found out another 100,000 ounces. So in our mind, there's no doubt we'll get our 7 years. In fact, we think it'll be easily 10 plus. So we're not worried about that. But nonetheless, investors saying, okay, that might work out, Kevin, but it's not baked in the cake yet because it's not officially reserves. So we structured our stream on this asset so that we get paid back in 3.5 years. So if for some reason the mine has 4.5 years and stops completely, which would be extremely low probability, we still get our money back in 3.5 years and a profit in the last year, and then we've made a bad decision, but we still win. So we've structured the deal itself to make sure that we still win.
Okay, that makes sense. That was a great explanation. I really appreciate that. I want to get to the calculations of this and the net asset value, a common calculation NAV. And you were just mentioning with wealth creation portfolios, you're creating more NAV, either through exploration or whatever, which it sounds like you factored in and it just happened.
Yeah.
Now, there's a industry you need a discount rate for NAV, and there's an industry average. Do you use that average, or do you factor in jurisdictional and managerial risk, or is that a whole different checklist not even included in NAV? How do you view NAV and the industry
Okay,
norms?
so good question. So look, if we're going to invest at all, we've already accepted the jurisdictional risk and sort of the soft risks around the asset. Once we decide that we're going to invest, what we're prepared to offer the counterparty is very much dependent on what the wealth creation yield is again. So if we think the wealth creation yield is exceptional, as it is with the Elk Gold royalty we just purchased, then we're prepared to pay at the low end of our sort of 5 to 10% financing costs. If it's not as good, and we'll go for a higher yield. And with Copperstone, we got a higher yield, but it wasn't that the geologic potential wasn't good, because it is good. The problem was our stream steps down from 10% to 3.3 to 1.2. So we're only getting 1.2% of that tail of whatever they add to the mine. So our ability to benefit from the exploration upside's a bit restricted. So we took a higher yield with Copperstone and a lower yield with Elk Gold. And on the Elk Gold, I'm going to give you one metric. Based on their finding costs for gold, every $1 million that they spend exploring translates into $4.5 million of payable gold to STAR at their current success rate. No guarantees that'll continue, but the mining lease on that property is only 1% of the total land package, and there's lots of exploration outside going on it's quite good. So we think this is going to be an exceptional long life wealth creation asset for us.
Okay, I want to get into Elk Gold too, because it's interesting. You're in the industry where, like, you made the deal with Amadex, or Amadex, I think I'm pronouncing it right. They're a well-respected company, and why would they want to sell a royalty that will be cash producing in the near future? And I want to get your take on the nuances and the soft skills and the negotiating skills required to do these asset changing of hands here, because someone must be happy in the short term, or maybe it's the calculation side. Like, can you explain?
Yeah, so look, Almadex and the parent company Almaden, they're project generators. So they look to set up exploration properties, joint venture them, maybe create some royalties and sell them. They make their money by moving their assets around successfully, including the royalties. We actually approached Almadex a couple of years ago as a private company to see if this royalty was for sale, and it wasn't. I think Gold Mountain approached them in the last year to see if it was for sale, and it wasn't. We had already built a model on the Elk Gold mine ourselves, because we thought this mine might need some capital to expand in the future. So we were paying attention. We built a detailed model on it. And when this asset came for sale in late August, we knew exactly what the royalty was worth, right down to the last penny, based on the 5% discount rate. So the offered price, we were approached by a banker and said, look, this is a competitive process. A number of your peers are in here bidding for this thing. And he told us the price, and we said, look, that price is a bit high. If your vendor wants to negotiate, we're happy to carry on. If he thinks he can get the price he wants from somebody else, then we'll respectfully just walk away. So we got an answer back within 20 minutes that not only would they be willing to negotiate, but they really liked our STAR Royalties equity, the upside potential. So they said they wanted a 10 million US cash minimum. And then whatever we negotiated above that, they would take in STAR equity. And they said, if you agree to give us some equity, we will give you an exclusive for 30 days, I think. And so that was the arrangement. And so we got the deal because of the value of our equity. But at the end of the day, we paid them 5% discount rate on what was known. And they're going to take the 10 million and the STAR shares and use that to develop their business. They're selling it not because they're unhappy with the outlook for Elk Gold, but because in their business plan, they need $10 million to do something else.
Okay, that makes sense. And like you said, they saw value in STAR Royalty shareholders. So let's say, hey, I like what Kevin has to say. I'm going to do more due diligence. I'm going to look into STAR Royalty more. And I do my due diligence and I say, I want to invest in this company. I go to my brokerage account and I see there's STRR, the stock, and then there's warrants.
Yeah.
Which investment vehicle should I take? What's the difference?
So I won all those awards for risk-adjusted returns by not buying warrants.
Oh, okay. Yeah, because they fluctuate more, right?
So look, I've made money on warrants. I'm being a little bit facetious. I have made money on warrants, but obviously, like any option, it's much more risky than owning the underlying equity. I think even today, I've got friends who own the warrants. They've been buying the warrants. And I say, well, good for you. I think that can work out. But on a risk reward basis, I personally would just buy more STAR equity, right? Because the STAR has to go up almost by double before the warrants get in the money. So at the moment, look, you can buy any warrant that you like the underlying company of, but it's a small bet. If you want to do it, it's a small bet. For your big money, you buy STAR Royalties parent company.
Thank you for that. Appreciate that. And at the beginning of this interview, I did mention I listened to your Bill Powers conversation, and I'm paraphrasing here, but you said something along the lines that when you were managing a portfolio, that if you see there is an issue, you would sell the position and wait a few quarters because some of these issues can last quarters to resolve. Is that how you should play this speculative early stage growth company space?
I think for all investors, sophisticated or unsophisticated, you don't need the stress of trying to wait out a problem that's happened. And particularly if you're not really in touch with the industry and all of the financial and technical implications of what's happened, you're better off to say, okay, look, this didn't work out, take your loss and move on to something else. And then you can follow the company and maybe get back in a few months later, a few quarters later. And in my experience, I would say 80% of the time, you can get back in cheaper if you like the story. Just wait, just watch it and wait and get back in cheaper. So I would still think that's the way to go.
Man, it sucks taking those losses, eh?
I've taken some large losses, and one of the problems for me is I used to run concentrated portfolios because I thought it was challenging to find companies that ticked all the boxes for me. And when I did find them, I'd take big positions. So I'd often own 19.9% of a company.
Wow.
And so sometimes I got myself in a position of being in a situation that was reasonably liquid. So I could exit my position over a reasonable period of time if I wanted to, but then something bad happened and the liquidity dried up. And so you're kind of locked in. Fortunately, if your listeners, they're smaller investors, they can move in and out pretty easily. But if you're trying to move 10 million shares, it's a problem often.
For sure. I want to ask you a question because I know you mentioned it a few times in other interviews that you saw this opportunity in STAR, but on one of the conditions you said you don't want to take a salary, you want to have shares in the company.
Yeah.
But why did you even decide to take this opportunity anyway? Don't mean any disrespect, but you probably could have retired long ago.
Yeah, look, I effectively did retire in 2017. I spent a couple of years putting an addition on my house. When that was done, I got a little bit restless. I kept in touch with some of my mining friends like Peter Buras. And when he told me he was getting involved in this royalty opportunity, I said, tell me more. And he said, well, why don't you come have a look at it? Maybe you can be a consultant. So I did. I came in, I made a few suggestions that they liked and they acted on them. And then they surprised me one day by asking me if I wanted to be the CIO. And I said, absolutely, I would love to get involved in this story, particularly with you guys. See, we've all worked together, we know each other, we respect each other's abilities. But I did say, I've got a few conditions. And the first condition is you can't pay me anything. Because from a governance perspective, I don't want to be ever on the receiving end of criticism that I'm taking too much money out of the company, no matter what it is. So I just said, just give me nothing. Secondly, there's some founder stock that's been issued. I want some founder stock, but they said, okay. And I said, but you can't issue any more founder stock. There's enough already. So sell me some of yours. Oh. So the guys chipped in and sold me some of their stock. So we didn't dilute the stock anymore by having me come in. And then I said, okay, let's raise some money and I'll put a check in and let's get going. And so, look, I think it's even from a selfish perspective, not taking a salary might seem a little bit strange, but for me to take a salary and then pay the government 50% tax on it, increase the cash burn on the company when we're trying to get off the ground without cash flow. I want to make this business growth as low risk as possible. So I don't want to be taking cash out when we're trying to build cash. And secondly, if we're successful in growing this company to a well-established, well-regarded royalty company, it'll be trading at 15 or 20 times cash flow. And I'd rather take a capital gain on my shares at some point in the future at 15 or 20 times cash flow than taking money out now and losing half of it in tax. So
that's a good segment to my last question before the vault. 15 to 20 times cash flow. And I was talking to someone last week about these early stage companies, and he said marketing plays a key role in them because we're like tech startups. The market needs to hear your story. Yes. Do you agree with that? Because I know you're very calculated with the numbers, but what's the importance of marketing with these companies? Because there are some royalty companies that trade well above NAV, some trade around NAV, below NAV.
Yeah. So look, I think marketing is very important. When I was a portfolio manager at Century Investments, I used to travel across the country, once or twice a year, stopping at all the small towns and big cities and explaining to people what I was doing with the portfolio, what my outlook was for gold was, and all that sort of thing. Just keeping in touch with them and basically maintaining their confidence in what I was trying to do for them as a portfolio manager in the gold space. And that was very important. I found that my assets were very sticky. So even when the market got hit once in a while, people didn't flee. I kept the money in the fund, and that made it much easier for me to manage during a downturn. You could actually redeploy capital more easily instead of being forced to sell stocks at a low price because people were leaving, right? Big plus. In the junior space in particular, I think marketing is extremely important, particularly because it's a fact that if your market capitalization is below a certain level, I'm going to say arbitrarily about $100 million, you're not going to get the institutional appetite for your shares simply because you're too small for them. You're not liquid enough, you're too small. And we've had a number of portfolio managers who I know well say, look, we like what you're doing. Give us a call back when you're $100 million. And at the moment we're, $30 to $40 million. So we got a ways to go. So when you're in that position where your access to institutional capital is somewhat constrained, and I will say that we've got institutions now owning 45% of the company. So it's not like they're not buying it, but it's not everybody's cup of tea at this small cap size. It's important to expand your audience. It's always important, but particularly important, as you say, right now, when you're not well known. And so as such, we're trying very hard to penetrate the US market in particular with our marketing, because I'm pretty well known in Canada. I don't think too many people know me in the US or the rest of the STAR team. Tony Lesiak, very well known, investment banking, research analyst, Canaccord Genuity, but we're not that well known in the US. So we're trying to focus in the US, and doing interviews like this is helpful. Thank you. So yes, it's important.
No, thank you. I really appreciate your time on this program, and I'm going to respect your time, but we do have a recurrent segment here. It's called the Vault. And in the Vault, it's just 3 mentorship-like questions, not related to Star Royalties, just questions I ask, the same questions to each of my guests. And it's my favorite part of every episode. So guys, if you enjoyed this conversation, make sure to like, subscribe, share, get the word out there. But let's get into the Vault. So Kevin, in the Vault, like I said, just 3 questions. First question, what did your parents teach you at a young age that has stuck with you to today?
Yeah, I think for my father in particular, my father was a child in the Depression, and he was taken out of school when he was 16 years old and told to go to work to support the family. So he never got beyond high school, not even beyond grade 11. And I think that severely restricted his career over time. He was a construction foreman and a surveyor. And he always emphasized to me the importance of getting a full education and using that education to your advantage. And so I always, I took the toughest courses I could get and tried to make something of them. And it's worked out well. So I appreciate that he instilled that attitude in me as a young person.
Good answer. Second question, we are the Wealth Holders podcast. So can you name a high net worth individual or a wealth holder? And if you don't want to disclose their name, that's perfectly fine. But what did he or she teach you, either in business or in life?
Yeah, I'm going to name a guy. He's deceased now, unfortunately. His name is Bruce Williams. And I met Bruce back in the 80s. And Bruce was a tailor who became a bookie, who became an investor. So I won't comment too much on the bookie business, but it did a little bit of something on the side. But he used to come into the office And he would bring with him a few prospectuses, on Chrysler, on Lockheed, on companies that were basically going into bankruptcy at the time. And he'd say, look at page 41 of this prospectus. Their preferred shares are protected by the following covenants, and they're going to be paid out at full value. No matter what, even if this company goes bankrupt, they're going to get full value, and they're trading at 25 cents on the dollar.
Mhm.
Load up on these preferred shares. And so I would, and he became a millionaire, which was back in the 80s, being a multimillionaire was a big deal. And here was a guy, I don't think he had too much formal education, but he just applied himself to understanding every detail of these prospectuses and the publicly available information. And I was so impressed with the process. And he actually pointed out to me at the time a few accounting tricks that companies use that confused you as an investor as to what was really happening. He said, you got to go to the footnotes. And he really pounded that into me. And I think he elevated my game, to just pay attention to every detail. And so poor Bruce, rest in peace. He was a great mentor to me.
That's good. That's good. Hopefully you can be a good mentor to us. The last question, any advice for the 26-year-olds or just the younger listeners out there?
Yeah, well, I'll say one thing. Take the Canadian securities course. It doesn't take long. It doesn't cost much. Get your foundational understanding of how the market works, what assets are available in the market to invest with, how they correlate with various things. What are the rules of investing? What are the hard rules of investing, the ethical rules? Learn all that stuff. If you're going to be in the business of investing, get your foundational education. Not that hard to do.
Great advice. I would have never thought that. That's great advice for the listeners out there. Thank you, Kevin. I appreciate your time. It was a real pleasure chatting with you. I do like letting my guests close off though. So here's your opportunity to say what you like to the listeners out there.
Well, first of all, my pleasure for being on the show. Thanks for having me again. Look, I think one thing that STRR Royalties is trying to do is we're trying to be best in class in all the governance aspects of running a company. We have the ability to start from scratch and run a company in the ways that we think are imperative. And we spent, again, so many years criticizing companies for doing things wrong. We're trying to do things as best we can, right. So if you're looking for an ethical management team with a decent skill set, I think STRR Royalties offers that opportunity.